Welcome, everyone. So today's explainer, it's going to absolutely fundamentally shift how you think about wealth. You see, schools teach us all about the math of earning an income, right? But they rarely touch on the actual mechanics of keeping it. Today, we're diving into some incredible insights drawn straight from top experts in financial history that prove your financial success isn't just about the numbers sitting in your bank account. It's actually about how you think, how you behave, and those silent psychological habits that separate the truly wealthy from, well, everyone else.
Let's dive right into this with a scenario that really perfectly frames what we're talking about today. Imagine two people, okay? They have the exact same financial potential. Yet one ends up retiring a multimillionaire, and the other, they struggle with crushing debt. How on earth is that possible? Take the real-life story of Ronald Read. He was a lifelong janitor who quietly amassed an $8 million fortune by the time he died. Now compare him to Richard Fuscone, a Harvard-educated finance executive who ended up filing for bankruptcy. The difference between them? It wasn't luck, it definitely wasn't raw intelligence, and it for sure wasn't knowing how to perfectly time the stock market.
The answer actually lies in the psychology of money. As best-selling author Morgan Housel brilliantly explains, money is not just a math problem. It's behavior, it is emotion, it's discipline. Becoming wealthy depends entirely on how you think and how you behave with the resources you actually have, completely regardless of the size of your paycheck. Which means people with incredibly high salaries can easily go broke, while ordinary people with totally average incomes can quietly build massive fortunes. It's a total game changer when you realize this.
So let's jump into Section 1, Myth versus Reality, the true meaning of wealth. You know, society constantly trains us to revere being rich, having a high income, flashing those highly visible, super expensive possessions. But here's the catch. That flashy luxury sports car, it might actually be entirely funded by massive loans. People living this way are rich in appearances, for sure, but they're often poor in reality. Being wealthy, on the flip side, is what you don't immediately see. It's the modest, everyday car driven by someone who quietly has millions invested. Wealth is assets, it's savings, it's ownership, and ultimately, it's financial freedom. The richest-looking person in the room is rarely the wealthiest person in the room.
Moving right along to Section 2, the psychology of choices. Behavior beats brilliance. History is absolutely packed with incredibly brilliant people who just make terrible financial decisions. Think about it. Predicting markets with a genius IQ? That isn't actually what wins the game. The true winners are the ones who master emotional control, patience, and consistency over time. You literally don't need extraordinary intelligence to be successful here. Ordinary people achieve financial independence every single day simply by locking in that emotional control and staying fiercely, stubbornly consistent year after year.
Which brings us to Section 3, the silent saboteurs. What keeps high earners broke?
Fear, greed, envy, overconfidence. These four emotions, they are the silent assassins of wealth. Think about it. Fear makes you panic sell at the exact wrong time when markets tumble. Greed pushes you to chase trendy, hyped-up investments way after the prices have already skyrocketed. Envy basically convinces you to buy things just to impress your neighbors. And overconfidence tricks you into thinking somehow you can outsmart the entire global economy. The market absolutely does not reward emotional reactions. It rewards discipline. The most successful investors haven't magically eliminated these emotions, they've just learned how to master them.
And honestly, that brings us to one of the most dangerous, sneaky traps of the whole bunch: lifestyle inflation. Okay, picture this. Imagine you get a massive promotion. Your income shoots up. Amazing, right? But then, almost magically, your expenses rise at the exact same rate. You buy a much bigger house, a luxury car, maybe some expensive vacations, designer clothes. Before you even realize it, you are earning twice as much, but you literally aren't saving a single dollar more than you were before. This right here is exactly why so many high earners are secretly broke. Every single raise is immediately eaten up by higher spending. The truly wealthy, on the other hand, they deliberately increase their investments way before they ever upgrade their lifestyle.
Now, I want you to really think about this. It's a crucial, kind of uncomfortable question. Do you know when enough is actually enough? Because one of the most dangerous words in all of finance is simply the word more. More income, more status, more possessions, more risk. So many people lose absolute fortunes simply because they never learn to stop chasing more. The greed just pushes them right into reckless decisions. Look, understanding exactly what your financial goals are and actually knowing when you've achieved them is vastly more valuable than constantly running on this endless, exhausting treadmill.
Let's look at how to get off that treadmill in Section 4, the invisible engines, how wealth is actually built.
Your greatest asset here isn't money, it's time.
And that's thanks to the absolute magic of compound interest. Let's break it down. In your first decade of investing, the growth appears painfully slow. Honestly, this is where most people just give up. But if you hold on into your second decade, that compounding really begins to snowball. The money grows, and then that new growth produces its own growth. It's wild. By the third decade, time is doing all the heavy lifting for you, resulting in some really substantial wealth. And yeah, for sure, the stock market experiences recessions, crashes, and crises. But historically, diversified investments just continue to grow over long periods because markets adapt and businesses recover. You really don't need to perfectly time the market. You just need to give your investments enough time to grow.
All right, here is the big one. Section 5, the playbook. 7 rules for financial freedom.
Consider this your daily manifesto for building wealth. Rule 1. Spend less than you earn. It is literally the unbreakable law of money. Rule 2. Save before you spend, always paying your future self first. Rule 3. Invest consistently, allowing that compound interest we just talked about to do its magic. Rule 4. Don't compare your financial journey with others. Envy is a massive wealth destroyer. Rule 5. Always remember that patience is infinitely more valuable than brilliance. Rule 6. Avoid unnecessary debt whenever humanly possible. And Rule 7. Always choose freedom over flash. Showing off your wealth is pretty much the fastest way to lose it. Financial freedom, that is the ultimate prize here.
True wealth isn't measured by luxury. It's measured by freedom. You know, the biggest obstacle to building your wealth isn't the economy, it isn't inflation, and it certainly isn't the stock market. It's your own behavior. Good habits are rewarded in the end. Mastering your money gives you the freedom to choose, the freedom to help others, and the ultimate freedom to live life exactly on your own terms. When you master your financial behavior, you literally master your future. So I'm going to leave you with this one question to ask yourself today as we wrap up this explainer. Are you currently spending your money to actually build your freedom, or are you just spending it to look like you already have it? Think about that. Thanks so much for joining me today. Keep learning, stay disciplined, and I will see you next time.